Hey everyone, this is Addy. Hey, so today we are going to talk about a very basic concept, beginners friendly, a complete beginner's guide to on how to sell options. Um, my disclaimer on this is I've been trading options for a while. I wasn't profitable at the beginning because I was buying options, I was buying spreads. I did not know anything about selling options. And then eventually, when I learned about selling options, I learned about playing the probabilities and mathematics in there, um, being the casino rather than the audience there, then I started making consistent profits. Now again, if you're gonna ask me like what is your yearly return, are you breaking the bank here? Are you beating the market that much? Well, not always, right? It's not a get rich quick scheme. This is a learning process, but it will teach you. My method will teach you a skill that you will be really useful for you in the future if you are looking for a job in this space, if you're trying to scale up your job, if you're trying to improve yourself, you improve your investing skills. Now, it's not just about options trading. We will also in the future talk about how to construct your own portfolio. Like, what kind of stocks do you buy? What is going on right now? What is your thesis in the market? Anyway, today's video, long story short, is about a beginner's guide to selling options. What buttons to click, what to look for, a step-by-step process of how to initiate a short option position and collect some data and premium. So here we go. Now we're in my TD Think or Sim platform. This is my paper trading account. I have my real account on the other side where I have some positions on right now. The market that I'm looking for is crude oil. Now, crude oil market has dropped down quite a bit. It's trading around yearly lows, I would say. Implied volatility is up around its average, 30% is the average. If I have to draw a line here, year to date, or sorry, last 1 year, the line goes through the 30-31 mark. Fine. This is one of the biggest indicators that I look at, the most important one. Implied volatility. Where is it trading? If it's high, we sell options a lot. We use a lot of buying power. We use a lot of capital in the portfolio to sell options. When it's low, we do not use all of our capital. We only use 30 to 40% of our overall capital, 25 to 30% maybe, and then we keep everything. The dry powder stays on the side. We take longer duration when volatility is low, and we take slightly shorter duration when volatility is high. So volatility impacts option prices quite a bit, and that is the reason why we look at it. And we are basically option sellers, right? So we are selling volatility in these options, um, and during that process we are gaining some theta because theta is positive for us, and then we are short gamma, and then the delta depends on whichever direction we take. So I'll take you through a crude oil futures option spread and a naked option as well. In case you like selling naked options, that's okay with me too. I do that every now and then. Another very important thing I look at in futures options and in any options basically is the volume and open interest. Now look at this volume and open interest column here in the crude oil market. Now these prices are delayed a little bit, but we don't care. 12,000 open interests, open contracts at the $60 strike, 55 days out. Now here's the thing: 55 days out, strike of 60 and 12,000. These are the most amount of contracts I see on the list in this market. Everything else is lower. There's a 12,000 open interest number here, 11,467 at 70. Now also notice that the full numbers, the 60s, the 61s, the 60s, the 63s, all have more open interest, meaning people trade this strike more than the half numbers. Look at the half numbers here versus the full numbers. I think I'm covering all over it, but yeah, just the idea is like always trade full numbers, full numbers, full numbers. Just focus on one product wherever the implied volatility is high. You think the market, and then as a contrarian, we look at the chart one more time. Now, let's go and look at the chart. The price has dropped quite a bit. It's trading almost around the yearly lows, not quite, but it's 74 versus 67. I've already taken a position in this in my real account yesterday, but I couldn't make the video. But here's another, just for learning purposes. Sweet spot, again, 16 deltas. That's my sweet spot. I will trade this at this level. This covers me for the yearly lows if the price drops. And then I'm going to buy one strike out. That's a put spread. Because I'm trying to go long, I'm going to sell a put spread. And how do I do this? So I will have to hit a bid. Now, when you're buying something outright, you will take the offer, which is the ask price. But when you are trying to sell, you will have to hit the bid because you are trying to sell to open this contract. Because we are selling, we are not buying. Again, let's take a look at the difference. If I hit the ask price here, the platform brings up the blue or the green bar here, which means I'm buying. Look, my signal, my side is buy, and I'm buying a single option. This number is too high, it should be around 1. I don't trade more than 1 or 2 or few contracts. Okay, so you're buying it at 78 cents. Fine. Now, if you do the bid, meaning you are selling. That's how it works. When you hit the bid, you are selling. When you hit the buy, so let's say you hit the buy and you bought this contract. Now, when you have to sell it, you have to hit the bid. That's why people look at bid-ask spread. When you get in, you are paying 78 cents. When you get out, you will only be able to sell this at 76 cents. If you get in now and you want to get out after 3 seconds, you will pay 78, and then people will buy it from you at 76, meaning you lost 2 cents already. Fine. That's why the bid-ask spread is so important. It shows liquidity, meaning if you have to get in and out, you get in at 78 to buy, you get out at 76 to sell. This spread has to be very, very narrow. In the crude oil market, it is very narrow. It trades very liquid. It is a very liquid product. So we don't really concern about that. Usually you can even see the penny wide bid-ask spreads, but 2 cents are fine. Okay, so now how do we open a position? 66 strike, I've decided that's my strike. 16 deltas, 55 days out. Okay, now why are we doing 55 days out? It's because if you look at the expirations here, everything else is like the monthlies I'm talking about, not the yellow ones. The weeklies I don't trade. There's not enough liquidity there. Or maybe there is, but it's just that, I don't like the markets. Well, actually, I'm not even getting anything here. So I don't look at these. What else? So the next available gray cycle, which is the monthly cycle for my range, which is around 45 to 50 days, is 55 days out. So I'm going to go in this one. I'm going to go down because I'm selling a put spread. I'm going to go down and I'm going to pick up the 16 deltas, meaning I am selling this. So I hit right click and I go sell and I go sell vertical. Now this vertical then brings up, it automatically picks up the very next strike down below. So you sold it at 66, the platform will buy the 65.5 here, but you don't want that. You want, like I said, you want whole numbers. So you sold it at 66, you want to buy it at 65. Your net credit is $13, 13 cents here, meaning $130. This product trades in $10 increments, fine? $10 ticks, I should say. So each tick is worth $10. Now it's trading at 12, meaning your total net credit is $120. So now we analyze the trade. First things I do is I go here and then I change the set slices button. Break even should be my actual expiration cycle, and I will have to change that here too, so that the chart actually reflects that. Now look at the probability of profit. The shaded area is what is this product expected to do between now and next 55 days. So based on its volatility, this is mainly based on volatility. So based on its volatility right now, this product is expected to stay between these strike prices. I should do a better job of creating better visuals here. But anyway, you get the point. It is expected to stay between 66.5 and around 83. So we are covered. Wherever it goes, we are good with that. The next thing I check is my total credit is 120. So now you can put your own limit price in there. Meaning I'm gonna sell one tick higher, or I will try to sell one tick higher, and then my net loss is like $870. That's pretty much it on this screen. This is the one standard deviation range, by the way, if you're wondering. One standard deviation range from now till 55 days out. This is how much this product is supposed to move. It's trading at this price right now. On either side, it's supposed to do this much. So on the downside, it's supposed to go down to this much, 66.25, whatever. On the upside, it's supposed to go to 83-ish. Fine. As long as my probability of profit, which is this number, is, I'd say is around, above 80 or close to 80 or 78, 79, I'm happy with that. Now, again, the next big question is how to risk manage this. Now, where's the risk in this trade? The risk is we are long in this spread. The risk is when this underlying product price, crude oil, starts moving down on us. Let's say it goes below 70. 70 is a good mark. It will be halfway through our expected range on the downside. So I'm going to start looking at managing the risk. How will I manage the risk? I'm going to convert this into a iron condor at that point, meaning I will sell the deltas on the call side. For my first line of defense is to sell the call side. So I'm going to go here. I'm going to pick 25 to 30 deltas, and I will sell the call side. So that will be around 78-ish at that point. I'm guessing it'll be around 74. Whenever that move happens, whenever that happens, that's my first line of defense. Convert this into an iron condor and then sit on it. Once that happens and you're closer to expiration, then I'm going to start moving the whole spread. And at that point, if I haven't really yet made the money, I'm going to start looking into moving the spread out. Meaning, leg by leg, each leg, I'm going to move the spread out into the next expiration cycle. And the reason why it's not showing everything is because it's now looking at just that one expiration cycle. So if you type this product in /CL, you'll see. So this next expiration cycle is for December. That's where I will look to move the spread afterwards. There are a lot of management techniques in this style of trading. Again, like I said, this will not make you rich overnight, but this is a higher win percentage for your options. Buying an option is a very low probability of happening. It's only 30% chance of winning. Here you get at least 70, 75. In our case, we got 80% chance of making some money, right? And hence that is the reason why I trade short options. It's a small amount. You will collect around, we will close this trade at $50, $60, 50, 60% of it. Fine. This is how much we do. We look to collect that much and then we risk adjusted. What did I do here? Why did this thing change? I think I clicked something and the chart has changed. Oh, it's gone up to 87. I don't know what I did. Or maybe I locked this up. Did I? Yeah. Anyway, our spread is still on. All I'm going to do is right click, confirm and send. Now look at this trade ticket. It will cost me $255 to put this trade on. Good amount of down payment, I get it. I will pay $4.50 in commissions to get in and $4.50 in commission to get out. So that's around $9 in total. Therefore, from 130, I should deduct 9. So my available credit is about 121, which I'm also fine with. Now, if you want to check your ROI, look at the ROI, right? You're only putting down 255. Your total net credit is 121. Now let's say you collect about $90 from that 121. You put that 255 times 100. That's 35% return. But this buying power effect will move around. It's not static. It's based on span margin requirements from the CME. Meaning when the markets are too volatile, if it goes up and down too much, this number will either go up or down. Fine. And the closer it gets to expiration, that's the biggest component of the spread margining, meaning if it gets closer to 20 days, 25 days of expiration, this number will balloon up. So we will look to close that trade in this cycle and move it to the next one. Last 15, 20 days, we do not stay in this cycle. That's when we roll. We roll the spread out, and then we collect more credit. We rebalance our strikes, recenter our strikes, and then we go again. Now this is 1 month of trading, right? Let's say you have to stay in this trade for 30 days. That's 1 month. You can do this 12 times a year. If you annualize this number, it's like in triple digits, but you should not be aiming for that much. Again, starting to sell options, it's a daunting task. That's why I'm here to support you, help you out. We will take spreads in the beginning. We're not selling any naked options, so that you are more comfortable with this whole process. It's important to understand this whole process, do a lot of paper trading, understand how to get in and get out of these products, of these trades. Anyway, so it then goes, let's say, send it, right? I mean, I'm pretty sure we'll get filled because it's a paper trading account. Everything just gets filled here. Actually, it did not get filled. Let's see, it's working. So this order is working. So I'm just going to take 12. It's trading at 12. It's a simulated account. I don't care. I just want to show you the fill trade. So I'll take it. There you go. That's the fill. Fine. Okay, now if you want to go to the Analyze tab, there you go. So your order is in, and we just wait and see like what happens. The idea is to keep monitoring, keep understanding the markets, how these products work, and this is just one futures options product. We have at least 20 that we can trade. Well, not 20, I would say. Maybe 12, 15 good ones that we can trade. We will talk about each one of them individually, and I will explain everything in those. Thank you very much. Sorry, one more thing. One last thing. I'm running, if you are wondering what's going on, I am running a free trading cohort. You can go on this link and join it if you want, if you like it, if you think it makes sense to you, just sign up. We are covering all these modules. Go take a look at these modules. If you think it's a waste of time, just stay away from it totally. And then just sign up. We will talk about a lot of basic option selling stuff, and then I'll take you through some real world examples on how to do this thing. Theory is one thing, doing it is a completely different thing. And I'll be here to help you out completely. I mean, even if you're stuck with something very basic, it's totally fine. I'll be here to answer questions. Thank you very much. See you in the next one. Bye.